Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Karen Shannoni, head of iShares fixed income strategy at BlackRock. And we know that BlackRock is the world's largest asset manager. We're talking about bond ETFs today. And iShares offers 349 fixed income ETFs globally and 106 ETFs, bond ETFs in the US. Karen, welcome. Thanks so much for joining us today.
Thanks for having me, Nina.
So let's start with the popularity of bond ETFs. We know that bond ETFs are becoming increasingly popular with a breadth of users, including institutional investors, individual investors. And I read from one of BlackRock's recent paper that global fixed income ETF assets totaled 1.3 trillion at the end of June 2020. And that was a growth of 30% in just 1 year. Very impressive growth. So talk to us about the factors that are contributing to this growing popularity of bond ETFs and what kind of growth you expect in the coming years.
Absolutely. We've seen so many investors who are discovering bond ETFs for the first time, and that's really contributed to the growth that we've seen over the past year. So just a bit of history, bond ETFs were launched back in 2002. So they're kind of 10 or 15 years behind the adoption that we've seen within equity ETFs. We saw the first equity ETFs being launched in the late 90s. So we're still seeing, I'd say, more people learning about them and using them for the first time. But I would say, especially over the last couple of years, that 30% growth rate you highlighted has really been coming from a couple of different types of investors. I would say the first is U.S. financial advisors. So many financial advisors are shifting from being managing money in brokerage accounts where it was more about turnover and trading revenue, and they're shifting more towards model portfolios. How can I get my stock and bond mix right for my client over time? How can I be a little bit more focused on the asset classes that I'm buying? And bond ETFs actually fit really nicely into that model because just like stock ETFs, most of them are designed to track an index. They're low cost and they're very tax efficient. So we've seen a lot of advisors who are using bond ETFs inside model portfolios and just to express views on the markets. The other big wave of adoption that we've seen is by institutional investors. And by that, I mean either pension plans, insurance companies, and even other asset managers, professional bond managers who are using ETFs as a way to have a liquidity sleeve, maybe as a substitute for certain derivatives, or even just a way to express a view on the market when maybe they don't have a dedicated trader in that part of the bond market. And I'm thinking specifically about emerging market debt. It's really easy to go out and buy a single bond ETF rather than having to go up and set up accounts in all these different jurisdictions. So I'd say between U.S. financial advisors focusing on low-cost, efficient ways to access the bond markets and institutional investors who are using them alongside individual bonds, we're continuing to expect that 30% growth rate to continue. So we'll probably soon eclipse over $2 trillion in global bond ETF assets in the next couple of years, just as we're continuing to see more and more users finding them valuable in portfolio construction.
Excellent. So we know that individual investors or institutional investors, they can choose to invest in single bonds or they can invest in bond ETFs. So there are definitely many advantages of choosing bond ETFs over investing in single bonds. So could you please highlight some of those advantages of the benefits of investing in bond ETFs versus individual bonds?
Absolutely. So what we tend to see is that a lot of investors who are individual bond buyers, lately they've been struggling with getting enough diversification. We've seen that new issues of bonds, especially in the corporate bond market, have been 3 to 4 times oversubscribed. So that means that for every dollar that gets issued, there's $3 of demand behind that. So they can have some trouble sourcing securities. It also takes up a lot of time to trade fixed income, to do the credit research. So a lot of the reasons why investors are turning to bond ETFs versus individual bonds are to have some of that operational efficiencies come into how they're managing their fixed income allocations. And I'd say some additional benefits are diversification. So what we see a lot of times, especially in the private wealth space, is that unless you have a lot of money that you can put into an individual bond portfolio, you might be limited to buying maybe 10 to 30 bonds. A lot of the separately managed accounts that people bring to us to analyze only have, 10, 15, 20 bonds in them. The benefit of a bond ETF is there's hundreds of securities inside each individual ETF. So that's really spreading around that credit risk. One of the biggest benefits that was really highlighted this year was liquidity. Individual bonds face what we call discontinuous liquidity. Sometimes they trade, sometimes they don't. Bonds trade most often right after issuance. Then they kind of get locked away in accounts for many investors who do want to hold them to maturity. So the benefit of the ETF is it trades throughout the day on exchange, just like a stock. So we're seeing people utilizing them either in lieu of individual bonds or alongside of them as a way to inject more liquidity into portfolios. And then we also see just trading, just ease of use. You can go out and try to buy or sell a bond. You have to get multiple bids and offers from different broker dealers. The fixed income markets, we like to say, are still a phone call market. While there has been some electronification of bond trading, a majority of that still takes place with having to call around and actually get prices on securities. The benefit of the ETF is you can trade it just like that stock on exchange. So it's really easy to just put in a buy or sell order like you would. You can even use limit orders if you like. So I'd say a lot of the efficiencies around trading and making those decisions. And I think for a lot of individual investors, one of the biggest benefits is just the income stream. Most bonds pay semi-annual coupons, so meaning you get a coupon once every 6 months. All of our bond ETFs pay out monthly income distributions. So you're basically getting, that same annual yield, but you're getting it on a monthly basis. So especially for retirees, that monthly income stream can align a little bit better with spending habits. So I'd say all of these reasons: diversification, liquidity, ease of trading, and then just the pattern of income makes bond ETFs sometimes more advantageous than buying individual bonds.
Right, and that also explains the growing popularity of bond ETFs. They just provide very convenient, low-cost way of getting exposure to a diversified basket of hundreds of bonds that you mentioned. And there are so many bond ETF options available to investors now. You can choose an issuer, whether it's a government, whether you want government debt or corporation debt or mortgage-backed securities. You can choose the credit quality, AAA or investment grade or even junk bond, and you can choose your maturity too. So I also read that bond ETFs have in fact improved price transparency across the entire bond market. Could you explain that?
So I think one of the biggest reasons we've seen institutional investors using bond ETFs is because they can get that price throughout the day. So if you think about the way the entire fixed income market is valued, it is set up around that the close of the bond market, index pricing providers will gather trade data on the bonds that have traded today, changes in interest rates, changes in credit spreads, and they will basically provide a end of day price for that particular security. And since not every bond trades every day, that's why they have to interpolate these prices based on this readily available market information. So I think that is one of the challenges of a fixed income investor is you have like last night's closing price, but then rates and spreads have once again changed in value or moved today. So then the value of the bond is might be worth something different. The nice thing about a fixed income ETF is that it is trading throughout the day. As we've seen more users using the ETFs, that there's I'd say a market information benefit where all of those different users are expressing their views and evaluating the bonds based on changes in market conditions. So you do get a very efficient price throughout the day. Whenever I'm watching financial news networks like CNBC, if there's, let's say, a change in something that would impact the muni market, they're using the market price of MUB, which is our national muni ETF, to show the market reaction to what's going on within those fixed income markets. And so what we tend to see is bond ETFs can even offer that price transparency and the cost savings relative to individual securities. So now we even see professional bond traders kind of looking at where the bond ETFs are trading, and that gives them some insight into changes in the bond market. And so I think that, with equities, it's pretty easy because all of these equities are already exchange traded. So you have that price transparency on the stock market. But with the bond market, it's still pretty opaque, and it's still a market where large investors have better access to information than small investors. So one of the benefits of being able to see the ETFs trade throughout the day in fixed income is really democratized the market. It's brought everybody onto the same playing field where we can all see the same prices, and that has information value. It's like my mom can trade, treasuries just as efficiently as a very large asset manager can, because you can now see the prices of that throughout the day on exchange. So I think that has a lot of benefits for investors, and that's another reason why we're seeing institutional investors increasingly adopting ETFs as part of their workflow.
Very interesting. So while choosing their bond ETFs, investors often wonder whether they should choose actively managed bond ETFs or use index ETFs. And in fact, we have seen that many active bond managers have been able to beat their indexes. On the other hand, most active equity managers have underperformed their benchmarks. So what are your thoughts on use of actively managed bond ETFs versus index bond ETFs?
I think most investors, when they start to approach the fixed income markets, they approach it from a lens of understanding active management. A lot of people want to hire a bond manager, maybe through a mutual fund or through a separate account, and they want that manager to manage credit risk and duration for them. So historically, when you look at how investors have accessed the bond market, it's through some of these vehicles where you have an active manager doing that for you. But what we see is that active management can't always protect on the downside, and that's a primary reason why people select those managers. What we actually tend to see is index funds, which are just designed to give you exposure to a specific part of the bond market, whether that is the broad U.S. investment grade market with an index like the Bloomberg Barclays aggregate, or if it's a very specific corporate bond index that maybe only has 1 to 5 years to maturity. Our index managers, for example, when they're managing our ETFs, are not going to be putting their views in the portfolio. They're not going to be adjusting duration and credit. They're just going to give you that part of the bond market. So what we've tended to see is that more investors maybe don't want their active managers making decisions and giving them tilts in the portfolios. So a lot of active managers, in order to beat their indices, will take on more risk, whether it's through credit risk or through interest rate risk. So the nice thing is if you've analyzed a part of the bond market and you're putting together your portfolio and you only want investment grade bonds, the index ETFs, that's all they'll deliver to you is the risk and return of that part of the market. But we have seen an increasing amount of indexed adoption, and this is a very parallel of what's been going on in the stock market. We've seen overall just a general rise in indexing within stock funds, and people have not wanted to go with active managers because they've either under-delivered or they've overcharged fees for what alpha they have been able to deliver. But we do still see in the bond market, there's some ability for managers to provide that excess return over the index. However, when we take a look at it now, about 25% of all bond funds, and that includes ETFs and mutual funds, are index funds. So it's up to about 25%. And then if you take a look in some categories like core fixed income, about 45% of the assets under management are now in index funds. And in some sector-specific categories like corporates, that's about 55% are indexed. So we are seeing a shift where a lot of investors are saying, if I'm just going with more plain vanilla exposures, if I just want maybe a core exposure, or if I just want a pure play corporate exposure, it's lower cost and more tax efficient for me to go ahead and express that view via an index ETF. But at the same time, we would really advocate at BlackRock a blending strategy. So we're seeing, we're recommending to clients that they have index funds at the core as a low cost component for those plain vanilla exposures. Then if you are going to hire an active bond manager, do it in a more flexible framework, meaning they're not just beholden to plus or minus a little bit around the benchmark, that they can go out and add value where they see opportunities, or maybe even a more unconstrained bond funds, which have been really popular in recent years, where they can really shift the duration or the profile of those funds. So we definitely see a world where active management and index management and fixed income can coexist. And we've seen much greater adoption of index funds for a lot of those plain vanilla exposures. And I think especially, Nina, as we're in a low interest rate environment, the cost of your fixed income investments is going to matter more as a portion of your total return. So I've noticed that there's been a lot of investors who have rethinking where they're paying fees in their investment portfolios. And if they're paying 50, 75 basis points for an exposure that they could replicate with index ETFs at maybe a third of the cost, that's where we're seeing some of the money shift and some people rethinking how they want to use active management and how they want to use index funds in their fixed income portfolios.
That makes a lot of sense. So let's talk about bond ETF inflows this year. So 2020 has been another record year for bond ETF inflows. And in fact, 2019 was also a great year, but flows into U.S. Fixed income products this year have already surpassed the total for all of last year. And the Fed is also responsible for that. We can thank the Fed for this, for these inflows, because they started buying a lot of bonds and bond ETFs, including Treasury bond ETFs, mortgage-backed securities, and corporate bond ETFs too. So do you think the pandemic-driven volatility and the Fed actions in the aftermath, they accelerated the growth of fixed income ETFs this year?
Yeah, I think the global pandemic and the market reaction caused a lot of investors to have a need to raise liquidity. They had a need to express views on the market, and and especially when the Fed cut interest rates 2 times in March, had a need to once again rethink where they were getting yield. So I think the rapid change in market conditions as investors were trying to understand the economic impacts of the global pandemic, I think really caused a lot of people to be open to newer ideas. And in some cases, that meant fixed income ETFs. So if you just think about what happened this year, at the beginning of the year, people knew that there could be market volatility around the election in the fall, but it was kind of like business as usual until February hit, and then the U.S. investors started to get concerned about the impact of the coronavirus and what that could mean for the U.S. market. And then as we got into March and states began locking down and issuing shelter-in-place orders, everyone was trying to get a handle on what that would mean in terms of unemployment and economic growth and inflation. So the immediate reaction was actually people sold bond funds and people sold bonds to either raise cash or because they wanted to reduce credit risk in their portfolios. So we saw that classic flight to quality trade take place where people went into government bonds. And in some cases, we saw a lot of utilization of our government bond ETFs. We have, I think, the broadest lineup of government bond ETFs. We have the whole curve, and we have all of the credit cuts, even Treasury floating rate notes, and a new strips ETF this year. But people were basically hiding in government securities and sometimes using ETFs to do that. And then as the Fed began to inject liquidity into the markets, what happened is it really changed. It changed the confidence level that people had with investing, particularly into bonds with credit risk. So it kind of went from you couldn't sell bonds fast enough to you couldn't buy them fast enough. And I think for a lot of broker dealers who maybe didn't have inventory readily available for investors, they could always go and buy them on the exchange via the ETF. So we saw a lot of inflows into credit ETFs, into broad market ETFs, and even in inflation-backed securities ETFs that track those parts of the market. So then throughout the year, we saw more willingness to take risk, and the inflows into ETFs continued. And then towards the end of the year, we saw some people taking off some of those government bond positions, and then we saw some outflows in government bonds ETFs coming into the fourth quarter. So I do think the pandemic related response and the COVID-19 sell-off really accelerated some of those trends, because ETFs are great for knowing what you own. They provide that transparency, and they're great for accessing a variety of markets in a very targeted way. and they're very low cost, which in a low interest rate environment is what you need. So that's what I think. I think if anything, it has accelerated the adoption of ETFs because investors began to recognize those benefits, and it was much easier to invest in parts of the bond market without having to go out and source all the individual bonds directly yourself.
So do you think these trends can continue in 2021? Because we know that COVID-19 vaccines are likely to become widely available by mid-year, and some of them, or most of them, will be very, very effective. And we should get a fiscal stimulus package too, either this year or definitely early next year. And that should boost the economically sensitive areas of the market. And in fact, we have seen a rebound in riskier assets recently. So what is your outlook for 2021?
So our BlackRock's outlook for 2021 is definitely around this theme of an economic restart. So as the vaccine gets rolled out, as everybody's available to safely go back to work, we were viewing the COVID market shock as more similar to a natural disaster, which is typically followed by a rapid economic restart with little permanent damage to the economy. This has gone on, I think, longer than we had expected. So we are expecting an economic rebound in 2021. But this is a little bit different than the 2008 financial crisis, which was followed by basically a lost decade of deleveraging and declining growth. So what we're thinking is, as the economy restarts, as more Americans are able to get back to work in those industries that have been disproportionately impacted by the COVID closures, we continue to see a rebound in riskier assets like credit. Having said that, we can look at where the credit spreads, and the credit spreads are just the additional yield premium that you can get over government bonds. So right now, the investment grade market is pricing in a little bit over 100 basis points, or about 1% over treasuries. So it's a little bit wider or higher yield than what we saw before the sell-off. So we're pretty neutral on investment grade credit. So that means if you own it, or if you're slowly buying into it, you can continue to do so because it's a place to get yield without taking a lot of risk. And then we do have an overweight to some of the riskier sectors. We do recommend investors are tilting a little bit towards stocks. And then in their bond portfolio, you can tilt towards high yield securities. And these are yielding about almost 380 basis points, or 3.8% over U.S. Treasuries. So you are getting more income to compensate you for the credit risk there. But you're absolutely right. Our stance coming into 2021 is that yield is going to be a more important driver of return. So where it's appropriate for your risk tolerance, you can add some more yield to portfolios with exposures like high yield bond and even some high quality emerging market debt.
That's very helpful. Now let's talk about the role of bond ETFs in an investor's portfolio. And we know that institutional investors like insurance companies and banks, they have to buy bonds and bond ETFs for their asset liability management and also for regulatory requirements. So we'll focus more on retail investors today. Talk to us about the role of bond ETFs and individual investors' portfolios and some of the implementation ideas.
Yeah, we love to say that, when people ask me, where should I get started with bond ETFs? I always like to take a step back and ask, well, what's the role of fixed income in your portfolio? And that will help lead you to the right ETF. And so I would tell people there's three broad roles of fixed income in the portfolio. Probably the biggest purpose is equity market diversification. We know that with equities, they are a huge generator of growth for portfolios. But as we saw in the sell-off, they were down almost 33% peak to trough in February and March. So if you could add some bonds to that, it's really going to smooth out the ride. So for those people who are younger, who have very equity-heavy allocations, you should think about your bonds as you want some safety in there. You want some government securities, some investment grade only. If you're just looking kind of for that one-stop shop, our broad market ETF AGG is simply holding treasuries, mortgage-backed securities, and investment-grade corporate bonds. So it's kind of that representation of the investment-grade market. And a lot of chief investment officers and other professional investors use the risk and return of this benchmark when deciding if their stock and bond mix. And then I would say if you're tax sensitive, if you're looking for equity market diversification, Our flagship ETF in the muni market, MUB, is another way that you could add high quality muni bonds to your portfolio at a low cost. So that's probably the biggest reason to have fixed income in your portfolios for the equity market diversification. The second purpose would, of course, be for stability. We know that sometimes people don't want to risk a lot of capital. It's more about preserving that capital than trying to get a larger return on it. And in the fixed income markets, that really speaks to going to a shorter duration portfolio. So sticking to something with maybe less than 5 years to maturity. So you're going to give up some yield to do that, but you're not going to have as much volatility. So I'd say one of the easy ways to get started with that would be maybe with a short maturity ETF. Let's say in the corporate bond market, we have an ETF LQD that just holds corporate bonds with 0 to 5 years to maturity. So that's another way that you could basically add some stability to your portfolio and still get a little bit of income. And then I would say the final reason is simply income. So if you have a very fixed income heavy portfolio, or if you just want to get kind of a 3 to 4% income on your bond portfolio, you really need to go down in credit risk in today's market. Government bond markets and even investment grade corporate bonds have lower yields associated with them. So taking on a little bit of credit risk, I would say the easiest way to get started is just with U.S. corporate bonds that are higher yielding. We have a flagship ETF, USHY, that just tracks the broad part of that market. I'd say another way that we see people building more income into portfolios is through our preferred stock ETF. And preferred stocks sit in between stocks and bonds in the capital structure. They tend to pay dividends or coupons, just depending on how they're structured, kind of in that 4 to 5% area. And we have an ETF, PFF, that just tracks that part of the market. So I'd say between USHY and PFF, you could put together an income portfolio only using 2 ETFs, but then you get exposure to hundreds of different bonds that are kicking off a lot more income than the investment grade market.
Very interesting. I know that is one of the challenges facing investors in this environment, especially those investors who are either in or nearing retirement. That is to be able to generate stable, safe income. And we know that rates could stay low, ultra low for several years. And for investors who are looking at dividend income to get those returns, but many companies have cut their dividends this year. So those ideas, PFFY and USHY you mentioned, those are really interesting ideas for income-focused investors. And I wanted to talk about bond ladder strategies with you now. So one complaint that we often hear from bond ETF investors is that these ETFs are perpetual. So you can lose your capital because they don't mature. On the other hand, if you buy individual bonds and hold them till maturity, then you get your principal back plus interest, and that is regardless of all market movements for those bonds. So I believe iShares has a solution for such investors. Those are called iBond ETFs. So talk a little bit about iBond ETFs, what unique features they provide to investors, and how can investors implement a bond ladder strategy with those ETFs?
Absolutely. We had a group of investors who do like their bonds to have maturity dates. And you're absolutely right. Most of our ETFs are quote unquote perpetual. They don't mature, although the bonds inside of them might. They just reinvest the proceeds back into other securities. So if you have a long holding period, I would say our regular ETFs are a great way to just consistently have that type of market exposure. But there are some investors who either want maturities in their bond portfolios, or they like to ladder them. And a bond ladder is simply a strategy where you're buying bonds that mature in different calendar years. For example, you could do a 5-year ladder where you allocate 20% of your portfolio to each calendar year. And then let's say your bond's maturing, let's say at the end of this year, you just take those proceeds and you go buy new 5-year bonds with them. So it's a way where you don't have to worry about, getting the calls on interest rate risk right. You can stay invested, and then there's that decision point when your bonds mature that you can decide where you want to go and roll the ladder. So we created a series of ETFs that are the best of both worlds, that have maturity dates like individual bonds. They trade like a stock on the stock exchange, just like any other ETF. And they're very diversified, like any fund would be. So when we originally launched these back in 2010, we started with municipals, and now we have them in investment grade corporates, in high yield, and even in the US Treasury market. So we're seeing investors using these to build bond ladders. You can simply go out and select the sector that you want. You can go out and select the calendar year. And you don't have to worry about picking credits, or you don't have to worry about trying to trade individual bonds with a bond broker. You can just do it like any other ETF. So we've had these iBonds ETFs out for 10 years now. We're now managing about $10 billion in assets under management. Over the last 10 years, we've had 20 different maturities of these, and they've basically delivered the yield minus the management fees roughly back to investors. So you can think about this like any other bond investment. When you buy it, you're going to earn a total return that's very similar to the yield at the time of purchase. So to help investors understand what they're getting with these, we have a tool on our website called the iBonds Ladder Builder, where you can go out and select which sector you'd like. You can enter a dollar amount, adjust the maturity dates, and right away it will tell you the yield, the duration. You can see the credit quality breakdown. You can custom weight your ladder if you don't want it equal weighted. So that tool's really helped a lot of our investor base understand how to think about using iBonds alongside individual securities, or instead of using maybe our perpetual ETFs. So we do see a lot of financial advisors using these. We have a few institutional investors who are using it for asset liability management, meaning they've got a cash flow they know that's coming up in the future. They want to invest with the maturity date towards that cash flow, and they're using the iBonds to do so. So we see it as a little bit nichier of a product set, but I think for those investors who are wanting to step out of individual bonds and into ETFs, the iBonds are a nice way to do that and still have those maturity dates.
Definitely very interesting products. As you mentioned, they provide the best of both worlds. So investors can have a bond-like experience while getting the benefits of the ETF structure. So I wanted to talk a little bit about ESG investing now, because we have seen a lot of interest both by institutional investors as well as by individual investors in sustainable strategies. And in fact, that trend is likely to accelerate under the Biden administration. So can bond investors access sustainable strategies through their bond ETFs?
They can. This is an area that we've really tried to build out more options for investors. So when we think about sustainable, we think about environmental, social, and even governance factors within securities. And then within fixed income markets, you can also invest in what we call green bonds. So these are bonds where the proceeds of that are going directly for an environmental purpose. So we've seen sustainable fixed income ETF assets have actually tripled year over year. So we're at about 2.7 billion in assets in these types of strategies. And I would say that we've seen a lot of people who have implemented environmental, social, and governance factors on the equity side of the market. And so we've really tried to replicate that with our fixed income ETF lineup as well. So we've just taken the approach that you could easily substitute out a core part of your portfolio using one of our sustainable ETFs. So we have EAGG, for example, is an ESG version of the aggregate index. So while AGG would be kind of our core flagship ETF, you could have the sustainable version, which is EAGG. You could also seek sustainable income. So we have 3 different ETFs that either invest in the investment grade or the high yield markets. And the companies that we've selected for those are ones that have better ESG scores than the average. So you're kind of still getting the income, you're still getting similar duration as to the broad corporate bond markets. However, you're getting the kind of best in class companies in the sustainable area. And then we do have a dedicated ETF that holds only green bonds, and the ticker is BGRN, or B Green, we call it, as a way to invest directly in those securities. So we're seeing investors basically using these fixed income ETFs to substitute out similar exposures that they would have. And that's just one of the ways that they could really boost the sustainable impact of their portfolios by using bond ETFs.
Very interesting. That's all we have time for today. Karen, thanks again so much for joining us.
Thank you so much.
Thanks for listening. If you want to learn more about these ETFs, please visit the ETF section of Zacks.com. And if you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments or questions, please email podcast@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.